So just to introduce myself, my name is Roxy Gwani. I'm the VP of Platform Operations at iFindTaxPro. We are a software company based on the West Coast, and we focus on tax solutions for tax professionals and clients. And we've put together this Tax Talk webinar and platform just to bring together different thought leaders and to keep people who are keeping a keen eye on tax movement, tax updates, tax, and as well as just educational content. So thank you for being here with us. Our special guest and expert is first Dmitriy Kustov, CPA, MS Tax, and he's an iFindTaxPro certified compliance professional with about 30 years of public accounting and tax experience. He's the founder of Kustov and Associates, which is based in San Francisco. It's a CPA firm, and he's an AICPA International Tax Committee member, as well as a published author. He has a startup tax guide, which is a must-read for founders and executives.
Awesome. Thank you so much, Rox. Excellent introduction. I just want to say a couple of words about our podcasts. They're daily. They represent various aspects of U.S. taxation in a clear and accessible way, and making them suitable for both the general public and those with a deeper interest in the subject. So we make it with the general public in mind. They're 10 to 20-minute episodes that cover select aspects of relevant tax rules and leaving room for future discussions. We in this podcast, we take a deep dive into key issues, analyzing recent court rulings and IRS regulations to keep listeners informed. I think that whether you're CFO or CEO, tax professional, or an everyday taxpayer looking to stay updated, our content offers valuable insights. During our live webinars, like today, we provide a brief overview of the materials in those podcasts, answer questions, and take suggestions for future topics. So here we're going to present to you the last batch, the initial. I should put initial batch of episodes dedicated to various tax topics. It's an inaugural batch, and topics are extremely interesting. Extremely interesting. First one is related to crypto rules. So crypto is the most, I think it's the most dynamic area of the business right now, right at this moment. Perhaps AI and crypto, they compete with each other. And this year promises to be quite productive in that realm. Hence the selection of our inaugural podcast. President Trump has an ambitious agenda for the tax reform, and taxation of digital assets is one of the hot topics right now. And some of the floating proposals are mentioned in the podcasts. For example, make US issued crypto non-taxable and make foreign crypto taxable at 30%, something like that. So we'll see what's going to happen. We don't know. But the podcast, for the most part, of course, it covers basic rules that exist right now in crypto taxation. And here they are. Here they are. So as we know, the gain and loss is realized and is taxable or deductible when the digital asset or crypto is sold for currency. Currency meaning is it for currency here is US dollar or any other foreign currency. Or when it's exchanged for another asset. And cryptocurrency is just, for now, is still treated as an asset for right now. I believe for taxation, we're still in the area of an asset treatment. So therefore, when crypto is exchanged for another crypto, you have what we call a realization event. And because of this realization event, you have either income, gain, or you have loss, depending on what the value of the purchase and at the exchange time. Okay. The transactions then netted out within the same year, you cannot go back. You cannot go back for the gains. So basically, if you realize gain in the current year, you could use losses from the prior year, but if you realize losses in the current year, you cannot carry losses back. So, and that's what, as we dubbed him, a stubborn taxpayer tried to argue in the tax court that he can carry those losses from the sale of the crypto back to offset his gains. And unfortunately, the rules currently such that you cannot do so. And it went all the way to tax court, and it was, of course, shut down there. But you can hear more about this case if you listen to the podcast. So therefore, I think maybe the main takeaway from this one is that when the year comes to an end, when the year comes to close, and even as you sell, let's say Bitcoin went up and you wanted to invest it for Ethereum and realize, and as such, you would realize a huge gain. I would strongly recommend you converting, I don't know, 10, 20, 30% to some sort to US dollars. I mean, if we're talking about US taxation, yes, that would be the least risky US dollars, just in case. What if then crypto goes down by the end of the year or by the time when you want to pay your taxes? Then you can get into this very unpleasant situation with a lot of gain and no money to pay the tax. So that would be not a well planned idea. And to provide us a little bit of insurance again, so I think it's wise to convert some of it to fiat or US dollars and put it on the pay estimated tax perhaps was that, or even put it on a money market account. It's even works that way. So in another points covered in the podcast, of course, everybody knows this year we have 1099K form that everybody is getting right now that covers payment processing services that process crypto transactions for $5,000 or more this year. So anybody who got crypto payments $5,000 or more through a payment processing service will get that form. Starting 2025 for this current year, brokers will have to report transactions on Form 1099-DA. That's you will see it in 2026. Not this January, but next January they'll start reporting. So beyond basics, for 2025, something to look forward to. IRS has issued new rules. I think it was procedures, right? Under revenue procedures, right? How we should calculate basis for crypto. It was a big surprise how they're doing it, and we're going to cover it on future podcasts, maybe within a week or two. So stay tuned. You'll be super surprised if you haven't heard of those rules, but it's quite different. Okay, so if we can go to ESOP slide now. Now next, our next podcast is employee stock ownership plans. I think it's an absolutely fascinating area that has been gaining momentum recently. At least a few people I know somehow either running funds or actively advising in this area. I don't know if you people are here today or not, but if you're here, it would be great. If not, we'll catch up with you later. So it's fascinating. Why? Shareholders can sell the stock to this ESOP while the corporation takes a pension deduction from its income. So you run a business, you take a pension deduction, the money goes into this pension plan, then you pay from that pension. Of course, it's once a ESOP decides to buy employer stock, it does, but effectively they're buying from you as a shareholder. And there is this amazing section 1042 that allows you to defer the gain on the sale of this if you reinvest the money within 1 year. So you're given 12 months to think what you're going to do with this money. There's another rollover if you sell to someone else. If you sell to someone else, you have to do it within 60 days. Okay. But here, when you sell to yourself, you get 12 months. And the assets in which you can reinvest are broader. So you can do a lot of interesting things. So you can listen to that podcast for more information. But I think it's an amazing tool, especially if you run a business or you know someone who runs a business, and they would like to incentivize their employees with ownership. You know, so and especially now in the current economy when U.S. is trying to rebuild a little bit how it's doing business, I think the this tool will be very, very on demand. So I would say we should look for it. And if anyone who's listening now or later, if you would like us to cover some areas of these rules more in depth, happy to do so. The court case that we present in the current podcast has to do with a situation where a former shareholder, the person who sold to ESOP, wanted to, they rolled over. They rolled over to 1042. They used 1042 to roll over, but then they borrowed something against that asset. And it so happened that they shouldn't have done it because it kind of blew this transaction. And the gain became taxable because there are certain limitations and things about it. Therefore, it's an amazing area, great opportunity, but one must be very careful how things are done. So there you go, employee stock ownership plan. Highly recommend to look into it and for yourself or your friends. Next up, episode number 3. It's digital sales transactions. As we all could observe for the past 30 years or so, the world has become more digital and more international. Now, digital assets and AI didn't leave the IRS another choice, but to issue the final regulations, finally, on how it would like to treat digital assets and cloud transactions. So they had it out as proposed regulations for quite a while, but we weren't sure exactly what would be final. And plus, if it's in proposed stage, you cannot rely on this yet, on those rules. That's why I felt like we were a little bit in limbo. We kind of think that's going to be, but it's not yet. But finally, in January this year, January 14th, I think, or 15th, they published it, finalized it. And now we have the rules, new rules. So these regulations mostly apply in an international context. I believe they should be considered by the CFOs and the finance team of the global entities because it's taxation and how products are packaged and where the sale occurs from. For example, if it's a foreign company, sells towards United States, or is it from US, sells to foreign jurisdictions, in order there's tax applied in US or in foreign jurisdictions, it will affect whether or not you can claim foreign tax credits or if you have to pay tax in the US. Okay, so it's I think it's a very important piece of rulings, and we're still looking at it and studying because they have 22 examples or even more actual examples in our, we're kind of digging into it right now. But the podcast already has a lot of valuable information. And to think about those rules, I came up with this mnemonic, cloud risk. So basically, IRS took this whole area of digital sales and it says, okay, let's have cloud transactions. That's what the cloud is, cloud transactions, or SaaS is the same as SaaS basically. Then we have rights. Then we have copyrighted article sales. Then we have sales of services. And then we have sales of know-how. So easy to remember, it's cloud risk. And then I looked up ChatGPT and it told me that cloud risk is actually a thing from social media. It's some sort of risk of doing something incorrect that's something to do with the government or regulatory, almost fitting very perfectly to our topic. Anyway, so now once, so all the digital sales could fall in one of those categories, in one of those cloud risk category. But then characterization depends on the predominant use of the product. So you can have complex product that can have some of those elements present, but ultimately they say we're going to view this product based on the predominant element in how people use it. So this is very important. Predominant use. It's a new concept. We'll go through an example very soon. But then once you determine predominant use, once you understand what type of transaction this is, then you can determine where the source of income, where is the source of income. Okay, so what interesting is that the copyrighted article sales now is pretty clearly depend on the billing address of the buyer. So you go to Stripe, to Apple or Google, and you have billing address. So whatever billing address is, that's where your transaction is going to be sourced to, black and white from now on. And then they say, but if it's abusive, if you just somehow put fake billing addresses or something like, I don't know what they're trying to say to tell us how abusive can it be. But if it's somewhat abusive, then IRS has the right to look into it and recharacterize it. But default billing address, and for 99.9% of us, that's how it's going to be. Then, but let's say if it's a cloud transaction, if it's software as a service, then it's services, considered services. And therefore, I guess that's my conclusion, the source of transactions where the servers are. Or I guess that's because the SaaS, software as a service, is provided where the services, where the servers actually physically located. Then, of course, it could be a number of terrible issues. If you use Amazon, you don't know where the servers are, or you know, but they change, and that's a separate matter. Will have to be dealt with later on application, but for now, that's the rules. So as I said, there are a lot of examples. We're still thinking about them. Here's the simple one. For example, imagine there is a TV shows, movies and TV shows, streaming, renting, and purchasing. So you can stream, you can then rent from them, and you can purchase. Easy. So renting classified as a lease of a copyrighted article because access is temporary and similar to returning a physical copy. So it's lease, naturally. Purchasing is a sale. So when you simply download it, you can keep a copy. Then it's a sale of copyrighted article. And again, sourcing and streaming, it's they distinguish streaming. They say it's not digital content transaction. That's the cloud transaction. And therefore it's software as a service. So in this case, streaming would be software as a service, and it will be a service, treated as a service. So now, one of the examples, if company, and here's an example for predominant use, okay? For example, company charges you for a streaming content. Let's say you're watching movies, it's all streaming mostly, but Sometimes you can download a movie. For example, if you know you're going to be offline, they allow you to download. It's saved on your computer, and then somehow it's deleted or you delete it later. Because the predominant use of how you're using the services is streaming, all of it will be considered as a streaming. So it's not going to be considered a sale of copyrighted article. Yeah, I think it's fascinating. If you guys want to know more about it or more about specific aspects of these rules, happy to put into the materials and make a presentation. As you know, those are 10 to 20 minutes. We cannot fit all the rules into it, but happy to listen to questions and respond to interest. Okay, that's it for this one, digital content transfers and copyrighted. So next we'll go to credits. So what's amazing is that this year, 2025, is 50 years since earned income credit was introduced. I have to say, in my early years in the United States, I loved this thing when I could just claim the earned income credit. It was such a good tax time. So I was looking forward to my tax time in that regard. But 50 years, so we decided to run a short podcast for credits that taxpayers can get. So we can have a child credit, $2,000 or $500, depending on whether or not you have Social Security or you have IT and then where you lived. I mean, not you, but children, right? So your dependent children, in order to get full $2,000 credit, you have to have Social Security. And if you want a $500 credit, you at least need to have an IT by the time when you submit tax return. Okay, so that's very important. And of course, regarding earned income credit, it can vary depending on the size. Of course, it can get some $1,800 per family. And we have a court case there regarding earned income credit, a situation where grandmother wanted to claim it for her grandson, but grandchild, and she couldn't do it because he didn't live with her or she didn't live with her for at least half a year. So there's one of the requirements. The child needs to be with you. So, and if child didn't live, therefore you're not entitled to that credit. Even though you can claim the person as a dependent under some other rules or some other variations, but not to claim the credit. So, and it's sort of it's a reminder for us to structure things properly. And of course, who can claim earned income credits nowadays? Probably grandmother is the best person to do that. Anyways, so the credit card, so it's a powerful tool. We should pay attention to it. 50 years, hooray, celebrate it. Okay, and the last one for me to quickly present. I know I'm a little above, over and above my time. It's a home office deduction. It's amazing. In how many? Maybe about like 10 years ago or so, I did an in-depth study, and if anybody is interested in reading my article, it's about 20-page article, in-depth study on home office deduction, how it's done, who can do it, what the rules are, and so on and so forth. And what I was amazed back then that every year somebody ends up in tax court, argues all the points that have been argued before, time and again, in different variation, and again, either win or lose. And it's amazing how you can never tell if they're going to prevail or going to lose. So the only thing that I had to take away, that if somehow you don't claim more than 25% of your home as a home office, for the most part, it doesn't end up in court. So basically, my big takeaway was, okay, just don't claim too much. Just claim no more than 25%, it should be fine. Statistically speaking, I'll look maybe at about 50 plus cases, if not more. And statistically speaking, I've never seen any smaller claims. It's always seemed to be like big areas. And so we have we have an amazing case that we will cover in this particular podcast. Oh, but before the case, let me tell you the basic rules. So you have to use your part of your home as a principal place of business for your business on exclusive and regular basis. Exclusive means that you cannot, I don't know, eat there, watch movies, maybe have parties with someone other than maybe business associates. And those should be business parties, not just any kind of party. And so it's pretty specific, but nobody knows what we're doing in our homes, so it's kind of easy to say I use it exclusively, and probably nobody would ever know, as long as you have a good area, normal area with a table and maybe a computer, a printer, or some other office things. So it's not very difficult to claim. And auditors, I know we've seen auditor objecting to reasonable area of the home or to reasonably looking office. Even if they might come 3 years after the fact, after the year of the use. But here, the taxpayer, in calculating the area, they simply added up the rooms. They didn't go with the actual footage of the place. They just decided, well, we have 5 rooms, and we're going to show 2 rooms as a business area. In reality, the area was 25%, but if you calculate 2 out of 5, it makes it 40%. So they claim 40%. It's no, can't do that. And it's amazing that things like that end up in tax court. So it's a case of another stubborn taxpayer. So there you go. Don't be stubborn, but good planning, arrangement, and not being too greedy, I think will go a long way in the home office real. All right. That was it. Thank you so much. Rox.
All right, thank you, Dmitry. I think that was very enriching. And as you said, I think we're going to need to unpack some of these rules maybe in a different format because it's very detailed. But I think for what we've covered today, I hope our viewers have gotten some great value. But I appreciate your time, Dmitry. And as we've mentioned, please visit our channel on Spotify as well as YouTube. Look for iFindTaxPro Tax Talk, and you'll get some more in-depth breakdown of each one of these episodes that Dmitry's covered. And if you have any more questions, do reach out to us. And also leave your comments in the chat if you have any questions that you'd like Dmitry to cover, or if you have any comments or suggestions, we are always open. So thank you, Dmitry, for joining us. Wonderful. And then also please follow iFindTaxPro on all the major platforms at iFindTaxPro. And please do comment, like, and subscribe to our channel.